Hi everyone, let's jump to our complex security valuation model. 3 employees of a tech company decided to form their own company in the tech industry and invested 1.5 million. The company has outstanding shares of 3 million. In the first year, the company spent a significant portion of its capital on developing the product. At the end of the year, it doesn't have enough capital to sustain operations. This stage business was still risky. It has a product and they need to deploy the product rapidly in the market. This requires significant capital. The question is how much they need to raise, whether they should also issue options for employees or existing founder shareholders, and the dilution of the ownership. Former colleague decided to invest in the company. We know that preferred shares has a downside protection. Preferred shareholders have the opportunity to get back their money before the common shareholders. The company issued a call option for 1 million shares with a strike price of $1. The question we have here is how we value company and how the value should be distributed among different equity instruments, preferred shares, common shares, and options. These equity instruments should be converted into a unit of account to value the company. In this case, our unit of account is the value of the call option. Here, as we don't have any external financing, any debt, enterprise value will be equal to equity value. And total value of the call option should be equal to total equity value. Here, we need to find the value of each equity instrument in terms of their share in the total call option. Break down the call option value based on different exit scenarios. We have different breakpoints, and based on each breakpoint, we have call option values, as you see on the chart on the right. Exit value, we have different call option values. Let's focus on the breakpoints. We know that preferred shares have liquidation preference feature that entitles its owners to get paid before common shareholders. So our first breakpoint should be 750. 750 is the amount, liquidation preference amount of preferred shares. At 750, the common equity value is 0. So after 750, the value increase will help the value of common shares until 250. Common shareholders will benefit because preferred shares have to convert their shares in order to benefit from the value increase in the common shares. So our next breakpoint is 250. Common share price is 0.5. Now there is an incentive for preferred shares to convert. As they convert their shares into common equity, they will give up on their liquidation preference. So our next break point is 4.5 million. This corresponds to $1 per share. Preferred shares are converted into common. Total outstanding shares increase to 4.5 million. So our next break point is 4.5 million. Now option holders have incentive to exercise their call option. The breakpoints are 750 to 250 and 4.5. We value each equity instrument based on their share in each equity tranche. So here in the first tranche between 0 and 750, the sole beneficiary will be preferred shares. In the second tranche between 750 and 250, common shareholders will be the sole beneficiary. After third tranche, as you see, there are two beneficiaries. Both preferred and common are beneficiaries. And after 4.5 million, all investors converted into common, and they all become the beneficiaries, and they share the total amount. How we calculate call option? We assume that preferred has 33.3% in the total equity, and we come up with $4.5 million fair market value for the equity. After our calculation, the seed preferred, after calculating call options and distributing the value among the different equity instruments, we observe that the amount is around 824,000. So this is roughly 10% higher than the transaction figure. So in order to calculate the equity value, we need to backsolve total equity value to come up with 750 for the preferred shares. So we, using backsolve method and goal seek, we come up with 750 for the preferred shares, which based on the transaction amount, we assuming the transaction amount reflects the fair market value of the equity, our implied total equity value is close to $2 million.